Welcome to Chapter 9. How do you value a bond and yield to maturity? This chapter has 4 objectives. The first is to understand simple interest. The second is understanding compound interest on bonds. The third is to understand the current yield. And the fourth is understanding yield to maturity. So let's get started. As you can remember from the chapter 8, that is previous chapter, we have our bond investor Joey, and Joey has his bond from the Dream Hotel Empires. And what he is going to do is, we are going to look at the different ways in which Joey can value this bond. So really, there are two different ways you can look at the simple interest or you can look at the compound interest. And under each one of these, you can see I have the coupon yield and the current yield under the simple interest, and then the yield to maturity under the compound interest. And that yield to maturity is really the thing that we have got to understand by the end of this chapter. So I am going to show you why all three of these are different and why the yield to maturity is the one that you really need to understand. So let's go ahead and get started with the simple interest. So in order to understand the simple interest, all you are going to do is you are going to add up all the values of the coupons, and you are not going to assume that you are reinvesting any of the coupons. You are just simply collecting those $25 payments throughout the entire term of the bond, and you are just adding those up, and that's your simple interest. The chart might look busy, but as you zoom in here and you look at the first coupon, you can see the first coupon for $25. The second coupon is for another $25. So the total that is running total that you see on the chart. So after two coupons, Joey would have $50 in his hand. After the third coupon, you would have $75, and after the fourth, you would have a 100. And as you continue to scroll down through the chart, you can see as we arrive at coupon 60 that Joey has $1,500 from all the coupons. And the way that was figured out was pretty simple. And I guess that's probably why they call it simple interest. You just take the number of coupons, which for this 30-year bond, you would receive 60 coupons, and you multiply that by the coupon payment, which is $25, and you can see it adds up to 1,500. So the way to understand the simple interest on this is, if Joey would simply buy the bond at the very first day and he hold on to the bond through maturity, and he wouldn't be reinvesting those proceeds from his coupons and just simply holding on to them, and holding on to the cash itself, the value of the investment would be $1,500. And we are not going to count the $1,000 he used to buy initially and the $1,000 he gets back at the end. We are just going to value all those coupon payments because that's the money that he made on the investment. So when we talk about the coupon yield, and this is under simple interest, the coupon yield is nothing more than taking 1 year's worth of coupon payments, which is $50, and dividing that by the par value. You are always going to divide all the coupons for 1 year, divided by the par value, and that's going to give you your coupon yield, which is 5%. And that's all there is to coupon yield. It's that simple. So when you talk about the current yield on a bond, you are typically talking about a bond that's been on the market for a few years. You are not buying it on the very first day. And so what you have to look at is the price that you are buying the bond for compared to the coupon payments. So in order to calculate the current yield, we are just going to take the coupon payment that you would receive for 1 year and divide it by the price at which you bought it for, that the bond itself, and you just divide those two numbers and you come up with the current yield. So you can see here, if Joey was going to buy this bond, regardless of how much time it was after the initial issue date, there could only be 1 year left on the bond, or there could be 25 years left on the bond. The current yield is taking that coupon, which in the first scenario here is going to be $50, and we are going to divide it by the price, and we are just going to say that the price that he is going to pay for it is $1,200. So when you do that, you get a current yield of 4.2%. Just 50 divided by 1,200. Now let's move out to the middle where the face value of the bond matches the actual price of $1,000. And you take that coupon of $50 divided by $1,000, because that's the price you are buying it, and you can see that the current yield would be same as the coupon yield. Now, if you talk about the bond that he's purchasing at a discount, let's say $800, you can see that the current yield goes up to 6.3%. So, in this example, we are talking about the same exact bond, no difference in the bond, just the price at which he's buying that bond at, and how the price is affecting the yield, because he's getting it at a more expensive or a cheaper price. Now, the problem with the current yield in this scenario is that it does not account for the amount of money that you lose or gain whenever the bond matures. Okay. So now let's look at the first one that we have, where Joey bought this for $1,200. Okay, the current yield on that is 4.2%. But what about the $200 that he's going to lose when this bond matures? Because we know whenever the bond matures, he's only going to get $1,000 back, because that's the par value. So this does not account for that loss of $200 that he would have whenever he would go to sell the bond. And so likewise, when you look at over at if you could buy the bond at $800, and regardless of how long he holds it, when the bond matures, the bond is going to be worth $1,000. So there is a $200 profit that is not calculated into the current yield percent that you see on the right side of the screen. So when we talk about yield to maturity, that's what is playing out. So just know that when somebody quotes you a current yield, it's not accounting for the difference between the price you are going to pay and the par value whenever the bond matures. So now let's talk about the compound interest on a bond. So as we look at our chart, let's go to the first coupon. So after 6 months, Joey would receive, and we are assuming that the Joey bought this bond as soon as it was issued, just like the very first scenario we looked at. And so you can see Joey would receive his $25 after the first 6 months, and then the second coupon, which would be 6 months later, is going to receive another $25 check. But here is what the difference. The first coupon of $25, we are going to assume that Joey has invested that $25 into another investment. Nothing to do with this bond, but he is investing that into another investment which is going to provide the same interest rate as what he is receiving on this bond, which is 5%. So that's the big assumption. Because in 6 months, let's assume Joey bought this bond right now, and then 6 months later, he gets his first coupon. Then, when he receives that first coupon, there is no guarantee that he is able to reinvest that first $25 payment into another 5% yielding security. So that's where, when you get into compound interest and figuring out what this bond is worth, there is a little bit of guesswork. So let's assume that whatever coupon yield Joey has on his bond is what he can reinvest his coupons back into at the same rate. So if that was the scenario, after Joey receives that first $25 payment, let's assume that Joey reinvested that into a completely different investment, that he invested it into something that's going to make him 5% return. So as we look at the second coupon, that initial $25 has matured into $26. And then Joey received the $25 second coupon for a total of $51 now. So as we look at the third coupon, we know that Joey has $51 that is maturing at a 5% interest rate as he is waiting for the third coupon, which is going to be another $25 payment. So each one of these coupons were assuming that the previous amount, that previous total is compounding at 5%. So as you can see, when we go through these coupons, when you get up to the 60th coupon, Joey would actually have $3,400 at the end whenever he receives his last coupon payment. So let's compare the simple interest versus the compound interest. You can see in the simple interest, this would be for the total duration, as if the first day that Joey bought it cleared up to 30 years later. On the simple interest calculation, you are only valuing the bond that is going to make $1,500 for you during the duration. But when you look at the compound interest, you can see that it's $3,400 if it is reinvested at 5% for each coupon. So that's a pretty big difference. We are talking more than double the money on a bond. So under the compound interest, let's look at the yield to maturity. Now, as we talked earlier, when we were talking about the current yield, we were not accounting for the difference that somebody would pay for a bond versus what the bond would be redeemed for whenever it reaches its term, and that the face value is paid back to the investor. So that's what the yield to maturity accounts for. Not only is that does it do the compound interest, but it also accounts for the difference between the price that you pay and the face value. So that's why this number is really important, because it really wraps all the variables together and it gives you a real estimate of what you are going to get if you buy any bond and hold it clear to maturity. And that's how we have to look at the value of the bond. So let's take the very first scenario here. And what we're going to assume is Joey is going to be buying a 30-year bond, but he's going to buy it 15 years after the bond has been on the market. So there is 15 years remaining until the bond mature. And each one of these scenarios are exactly the same. The only thing that we change between each of these three is that the price that the Joey is paying for each one of these bonds. Okay. So the first one, Joey is going to be paying a premium for the bond, meaning Joey is paying more than the face or the par value. So the first one, he is going to pay $1,200. Okay. So as we look down the coupon payments that Joey is going to receive over the next 15 years amounts to $1,098. Now we're assuming that Joey is reinvesting each coupon at 5%. Okay. So that's why you have a kind of an odd number there. So the coupon is $1,098. The par gain and loss, he is going to lose $200 on the fact that he paid a premium for the bond, and whenever it matures, he is only going to get 1,000. So he's going to lose $200 there. So the $200 comes right off of top of his coupon payments for a difference of $898. So if you buy this bond at that price, and he held it clear to the maturity, Joey is going to make $898. So as we look to the yield to maturity, so that yield would actually be 3.3% for that purchase price, okay, which is significantly lower than the 5% coupon that you might think when you look at it from the simple interest and coupon yield perspective. So let's go to the second one. Let's assume that Joey bought the $1,000 per bond. He bought it for $1,000. He has got 15 years remaining on it. And so the coupon payments, that the compound interest on those coupon payments would be same thing, $1,098. But he has no gain or loss from his purchase price to the face value. So the difference is just going to be the $1,098, and the yield to maturity is 5%. Okay. So when you are buying it for the same price as what the face or the par value is, you are going to actually get, and you are going to see that the coupon yield will be exactly what it says on the bond. So here is where it's really interesting. When we look at buying a bond that's selling at a discounted price, so we go down here. The coupon payments are exactly the same. The par value you are actually gaining because you bought it for 800, but you are going to get 1,000 back when the bond matures. So you are going to get a $200 plus. So your difference is $1,290. So a reveal to maturity on that bond is 7.2% a year, even though it is a 5% coupon bond. So you can see how much of a difference here occurs based off the price that you are buying these bonds for. Anytime you are paying a premium for a bond, your yield to maturity is going to be much different than what your coupon yield is. And that's the thing you really got to understand. And that's why understanding yield to maturity is the most important thing you can do when you understand how to value a bond. So now you might be thinking, how did Joey figure out that yield to maturity value? Here is the equation and the URL for the calculator. Yield to maturity formula YTM equals to C plus FV minus PV divided by N whole divided by FV plus PV by 2, where C is coupon, FV is face value, PV is present value, that is the current price, N is number of years to maturity. Or you can use yield to maturity calculator, free calculators available online. I use this inchcalculator.com/yield to maturity calculator that you see on the screen. where you can input the values. Face value of $1,000, the current price is 800, annual coupon is 5%, number of years to maturity is 15, coupon frequency is semi-annual. When you hit calculate, which is going to give you yield to maturity of 7.2%. You can do it for other two scenarios. So just a quick overview now. I want to show you the difference as we looked at those different purchase prices and the terminology that we learned all in one. So let's zoom in here and let's look at the very first one. So this would be assuming that the bond has been on the market for 15 years and that there is 15 more years remaining until the bond become mature. So let's look at it. If you would buy that bond for $800 and look at the terminology. So the coupon yield is still 5% here because in order to figure out the coupon yield, all you are doing is taking that coupon payment for the year, which is $50, divided by the par value, which is $1,000. So it's going to say 5%. As you 5%. As you look across the board, the $1,000 bond price would be 5%, and the $1,200 bond price would be still 5%. So you can see that it's really misleading when somebody gives you a quote based off of the coupon yield. That really does not mean anything because the price that you pay is going to be drastically affecting what you actually see on your yield. So let's look at the current yield here. To figure out the current yield, we are taking the coupon payments for 1 year and we are dividing it by the price that you are actually paying it for. And as you can see, the first one for $800 was 6.3%. That is 50 divided by $800 is 6.3%. And for the 1000 it was 5%. And for the $1,200 it was 4.2%. But those are not the real numbers, we know that. So when we go down to the yield to maturity here, this is actually counting for the difference between the price we are paying and accounting for what we are going to receive back on the face value of the bond. As you can see, the numbers get even more different than what you saw before with the current yield, where the $800 bond is actually going to give you 7.2% return, which is great. The $1,000 bond is going to give you a 5% return, and the $1,200 bond is going to give you a 3.3%, which is significantly lower. That is 1.7% lower than what you would be expecting if you were just looking at the coupon itself. So this stuff is really important. I would recommend that you go back and re-watch this video if it really did not sink in the very first time. Maybe even go back and start from the beginning and watch all three of these videos again, and it would really start making sense to you. Make sure you understand yield to maturity. That one is really important. So in this chapter we had 4 objectives. The first is to understand simple interest, second is to understand the compound interest for bonds, and the third is to understand the current yield, and the fourth is understanding yield to maturity. Thank you for joining me, and I am looking forward to seeing you in the next chapter.